We hit on it yesterday. It's been a big question, right? You have the S&P 500 less than 1% from its January high. Other indexes up in that area as well. But people have been kind of picking apart this rally since, let's say, February and saying, well, it's too narrow. It's just driven by big tech. This is a look at the S&P 500 year to date, as well as the equal-weighted version of the S&P 500 as traded in this ETF. And you'll see the orange line is the S&P. It's outperforming the equal-weighted version by about 1.5% year to date. So obviously, the largest stocks have had a greater influence on this rally, but the equal-weighted, basically the most democratic look at the S&P 500 is also participating to the upside. So what I would say is it's a selective market. The rally has not been all-inclusive. It's been rotating from strength to weakness depending on the group. Only 3 sectors in the S&P are outperforming the S&P itself year to date. So it does show you had to be in the right spots. Of course, the NASDAQ 100 up 16% year to date. The tremendous performance. So it has been big tech, but then small caps up almost 10%. So it's basically kind of this mix that's not necessarily been predictable in advance of what's working. And I say the average stock up year to date. Now, at some point, if you do have this spread between the very largest stocks and the median stock, it does become a less stable market. But I don't really think this is something to be too concerned about right now because most stocks are still up. There are twice as many stocks in the S&P up 10% year to date than there are down 10%.
And a massive relative outperformance compared to certain international markets
Without
as well.
a doubt, yes. And so you could look at kind of that tier of performance across the world, and it's big cap U.S., small cap U.S., and then the average U.S. stock, and then you, for the most part, the rest of the world. Yeah.